The broadcast is now starting. All attendees are in listen-only mode.
Hi, my name's Kevin Uphill. I'm the chairman of Avondale Corporate. We are leading M&A strategists operating throughout the UK and internationally, and we do about 25 to 30 transactions a year. I'm going to be talking to you about the process of selling a business today. The first element that we need to look at is what's actually happening in the marketplace today. The good news is we're still very busy, which may be a surprise given the Brexit story and how people are seeing that may impact on the economy. Fundamentally, mergers and acquisitions work better in slow growth economies than they do in fast growth, principally because there are too many businesses doing the same thing and there's a need to consolidate, but also because yields are difficult to achieve organically. If we look at yields in the stock market and also the property sector, at this point quite low, whereas in the small to mid market it's possible to get yields 15, 20, 25%. So there's an awful lot of energy and money moving into the smaller cap and mid-market cap sector. Brexit increases the uncertainty that we see in the economy, but as you can see from this slide, we've already got slow growth in the economy compared to recent periods, and we see that continuing. Slow growth fundamentally being caused by a shift of power from the west to the east, an aging demographic, and also significant debt balance sheets as a result of the 2008-9 credit crash. So slow growth probably for the next 10 to 15 years, pushing people to look at mergers and acquisitions. Brexit may add to the drag, but is another part of the mix. In terms of people who are buying, most of our buyers are looking at what we call a shareholder value play. It's 1 plus 1 plus 1 equals 6. The first one is the synergy. The second one is the economy of scale. The third one is securing shareholder value. Sellers capitalizing in, very often at a point when they're at a crossroads. It used to be historically that crossroads was driven by retirement, but increasingly it's a recognition that they may not be the right people to take the business forward to the next level, and a leap of faith as to what they're going to go and do next. So fundamentally we're very busy. Brexit may be causing further drag on the economy, but it's not impacting on the small and mid-tier sector. Being based near London, there's over £3 billion worth of private equity looking to be invested in this space. So actually very exciting times. But today, beyond the market, we're here to look about the process of selling a business. What are the steps involved? We talk about M&A strategy, M&A strategists. So for us, the steps are both preparing the business, but also then delivering the M&A process or exit strategy. And our sole game is to create strategic value. We are looking at beating what one might call the traditional accountancy value. The traditional accountancy value is typically based on the last 3 years' historic profits. Well, I can't remember what happened 3 years ago, so I'm not sure you can either. We are far more interested when we're looking at strategic value in what's happening today as opposed to what happened 3 years ago and what's likely to happen over the next year or two. So it's a multiple typically of the current profits on a sustainable adjusted basis, and also taking account of forecasts that likely drives what we would call strategic value. This image here is showing you how we see multiples and where valuations might actually sit. So you can see that multiple ranges run in the small to mid-tier sector from anywhere from 0 to 12, and in terms of profit, the bigger the profit, which is the top axis, 250k to 12 million, the bigger the multiple. The reason the multiple goes up, the bigger the business, normally the stronger the economies of scale and the stronger the sustainability, but also the more wealthy and or sustainable the buyer is, or higher multiple they are trading at, and therefore the affordability goes up. We're looking to try and get into strategic value on all the transactions that we work on. and that's a multiple of the adjusted sustainable profit, typically how we're looking at this. Most valuations are done debt-free, cash-free. So of course, when we're thinking about the M&A process, we need to also look at how we are preparing the company for sale, whether that's the balance sheet, debt-free, cash-free, or the profit and loss. The bigger the profits, the bigger the multiple. The bigger the current profits, the bigger the multiple. The stronger the forecast, the bigger the multiple. So our first step in the process of actually selling a business is to look at what we describe as value builder work, or shareholder value. Indeed, we should be asking this question from the very start of setting up a business. The question we very often throw at senior boards or shareholders is, how much time do you spend on strategy as opposed to management? Strategy is what new products, strategic alliances or acquisitions influence our multiple, whereas management is, are your team any good at the job, and how can you be more efficient? And it's really interesting to see that a significant amount of the energy in boardrooms is spent on management, not strategy. And one of the key parts to preparing a company for sale and engaging in the sale process is looking harder at where you can spend your time in increasing the shareholder value, and that is a strategic question. So for us, the first step in the process is getting shareholders to spend more time on preparing the company for sale, and that's about looking at their roles and responsibilities and moving them away from management into leadership. Ideally, the more team-driven a business, the more market-driven a business, the higher the value, and the less hands-on the leaders or principal shareholders are, the easier it is for someone to take over the business. So you can see there's quite a lot of work to do in actually orienteering a business ready to get the top value or strategic value when you go to market. So leadership, not management, looking at the process of an M&A sale right at the start in terms of both creating a prepared asset, as well as later we will see a process of actually delivering a competitive environment to get the best price. So looking at the time of the shareholder owners, where are they spending it? How can they improve their time focus on strategy and preparation of the company for sale? And some of the things that we can do, obviously, the better the systems, the more team-driven, the more sustainable the model. We also want to make sure that we're looking at the business in terms of how large the sector is, what the growth record in the sector is. Very often, our buyers are looking to take businesses and multiply them by 2 or 3. So it's quite interesting when you talk to business owners how often they don't know what percentage of the sector they already have, and therefore what those growth opportunities are. Quite often buyers are interested in buy and build strategies, and acquisitions would be a key part of the driver, or acquisition prospects may be a key part of the driver for them in terms of acquiring you. So we need to have some feel for how likely that is and start preparing the business to maybe be able to think about those things under new stewardship, new ownership. One of the other areas that you can work on when looking at strategic value, looking at strategic process of selling the business and preparing it, is also your niche and market position. If you've got a business that's the same as someone else's, it's easily comparable to somebody else's, then from a buy-side perspective, they are buying something less unique. It is easier for them to compare price. Whereas if you can create a situation where you have a particular niche, you're known for a strength, and you own that sector or strength, it is much harder for a buyer to create comparison when looking at valuations. So they are forced to pay a higher value. And that leads to brand and reputation. Quite interesting how often we actually help people reposition the business and the website as part of that sale preparation process. Fundamentally, behind the strategy of preparing a company for sale, we're looking to create team and market-driven businesses which are hands-off from the owner's perspective with more recurring revenue and enhanced profit. But assuming we've done that, and we're really talking about working often 4 or 5 years out, or even 3 to 6 months out. And from 3 to 6 months, we call that value builder. If you like, that's house doctoring, that's tidying the house up before you go to market. Obviously, if you go to market with a prepared asset, you are more likely to get a higher value. Value Builder is about looking for the small gains. So it may well be reviewing the contracts. So the way we suggest people work, put together a virtual data room and actually perform an element of reverse due diligence on your own business. Imagine you are the buyer. What are the threats, opportunities and weaknesses in your business, and how does that look in terms of where you can prepare the business for sale? What small changes can you do, if you like house doctoring, can you carry out on the asset in order to position it for the best price and the best conversations with buyers? So we call that Value Builder. So on most of the projects we're working on, we put together a virtual data room, produce that reverse due diligence report that looks at yourself and the buyer's eyes, and then we're looking at making tidying up exercises in order to help the conversation go through more smoothly with buyers. Fundamentally, when you're working on an M&A process, on an exit sale, we're also looking at a strategic approach to strategic buyers in order to get the best deal value. And that's about having a prepared asset, but then also going out and talking to the right people in the right way. We work on producing an information memorandum. That is a crafted positioning document, and it should include forecasts, but as I mentioned earlier, some flavour also for what market size there is, what market percentage that you may have, and therefore starting to look for buy side at the vision of where the business can go. Imagine if you had a viewing meeting with a buyer and you're sitting there saying, look, we've done really well, but actually we're starting to plateau. We're not clear how to take it to the next level. We're not sure we're the right people to do it anyway, and we're starting to run out of energy. That is far less effective than saying we've been in the strategy sector, we actually really understand how the business is doing, where it sits against its competitors, how it is growing against its competitors, and we're really clear how we can take it to the next level. As we've said, we may not be the right people to do that, but if we don't do a deal now, the price is going to go up as we get stronger and we continue to deliver growth. It's a far better strategic position as far as buyers are concerned. Ultimately, we're looking to get a competitive environment going, a bidding process, and within that we can then choose the right deal structures. Behind that, you need an M&A advisor that's giving you advice at every step and level. Let's look in more detail at the process. So step number one, project design. Do we need to take a longer curve out on this and bring strategic mergers and acquisition strategy to the boardroom to design the product more effectively? Or are we in a position where we can do house doctoring with that reverse due diligence and start tidying the asset up in order to position it best for sale? Then producing a really high quality data pack. That's a data room, an information memorandum carefully crafted with the forecasts, and also a teaser document, which is what we'd actually go to market with to discuss in the marketplace. Then we move into the research and profiling stage. Who are the best people strategically to buy this business and why? Who will get the best economies of scale? Who will get the best synergy? And who will gain the best shareholder value? That 1 + 1 + 1 = 6 that drives mergers and acquisitions value. So the profiling and research is really critical. And for us, that's all about using our business intelligence. We sit on 4 or 5 mergers and acquisitions databases. We look both internationally, globally, and also within the financial investment community. I mentioned earlier there's over £3 billion worth of private equity money looking for a home in the small and mid-market sectors. But also internationally is quite exciting. We've got a number of transactions at the moment. Italian company looking to buy, taking advantage of the euro, for example. So it's all about thinking about who is most likely to buy and gain best from the strategy. We often have the debate with sellers who feel that it's normally their top competitors that will gain the most value. And there's no question that competitors are key buyers. But actually, the best strategic value deals are normally slightly off-piste. They are buyers that sort of understand what you're doing, but they don't exactly do it. They therefore will place a higher value on the intellectual property that you have and the methodology that you have. After all, essentially all a competitor is doing is buying the economy of scale. They don't have the synergy, the ability to cross-sell, or the strategic added value by your know-how in doing a transaction. We want to make sure we're talking to people that have got the right balance sheet, the right funding position, and are in a position to deliver a transaction. We then go out on a crafted approach, and that's about bespoke personal conversations, talking to the CEOs, the key decision makers, and making sure it gets across their desk. And depending on the size of the transaction, there may be anywhere between 10 to 15 approaches up to 200 or 300 approaches. Obviously, more approaches, the smaller the enterprise that we're working with, less the bigger the enterprise. On top of that, you add the financial community and their corporate network of known acquirers as well. So very careful, selective research and profiling to create the environment. Ideally from there, typically on most projects, we would normally expect to get 10 to 15 non-disclosure agreements in. We're very selective about who we would suggest we meet. And ideally, we're looking to meet 6, 7, 8 parties at tops in order to get the strategic conversation in the boardroom going around the acquisition. This is not 100% a sales role. You will get a higher value if you go in on a strategic basis with those buyers in those meetings. And again, a good advisor will coach you through that. By that I mean it's a listening process. As much as saying you've got a great project and a great product and a great fast-tracking position, we need to listen to how that fits what they are trying to achieve in order to create a win-win scenario for both parties. If we're talking too much, we can't find out what their real buying triggers are. Ideally, of those 6, 7, 8 meetings, we want to keep them down to an hour, hour and a half. We do not want 2.5 hour long fact-finding meetings each time. So another key part of the process is referring back to the virtual data room to create more transparency online for the buyer, obviously within the bounds of confidentiality as far as your customers are concerned, so that they are coming to a meeting more prepared, more aware of what they're looking at, having done their homework. That means that you can concentrate on running your business whilst the process is going on, and the meetings are far more about the dynamics of the personalities as opposed to the strategy of whether there's a deal here or not. And ultimately that increases the conversion rate from viewing to sale and reduces the distraction whilst we're going through an M&A process. So that's the presentation of the opportunity. And the reason you need an M&A advisor that's an M&A strategist is because they're not just selling the business. Yes, there's a sales job, but they are also looking at the strategy of the deal, whether that's buy-side strategy, but also buy-side's potential deal structure when you get to a transaction. We call that transaction creation. So you're creating a competitive environment, typically securing 3 to 4 bids, playing the parties off effectively in an auction type style to push the price up. All M&A transactions are typically taken out on an offers basis, which enables the market to decide. This way we'll get the highest price. But transaction creation is not just about the competitive process and the competitive environment, it's also about the deal structure. As rarely are transactions all cash today on completion, and we need to look at that shortly. The next step, and our typical timeline for this, by the way, is 6 to 9 months from taking a project through the initial house doctoring value builder phase through to completion. Clearly, if we're working earlier on shareholder strategy, then that can be 3-4 years out. But assuming that we're doing value builder work, it's house doctoring and tidying up, typically 6 to 9 months for a transaction. So you've got transaction creation, that's creation of a competitive environment, 4 to 5 bids, play the parties off, get to a heads of terms. Typically at that point we move into transaction assurance, which is where we have agreed a heads of terms and we need to then project manage to complete the transaction through to completion. The good M&A house will be in there at every step and level, helping you orchestrate all the parties and ensuring that the transaction goes across the line. And some of the earlier work, we talked about Value Builder and preparing the asset, but also a quality data room, will really pay dividends at this stage because you're creating visibility, which means that the transaction's far more likely to go through on the terms agreed, because you're not meeting the typical, well, we've done our due diligence, we didn't quite understand it, let's talk again about the price. You've created that transparency, which removes those kind of conversations, increasing the chances of the transaction going through smoothly and quickly and at the price that you've agreed. Again, we've mentioned the word M&A strategy. When you're agreeing those heads of terms and you're moving into that completion phase, it's not just the price, it's the deal structure. And therefore, really understanding what both sides are trying to achieve is also critical to putting a deal through to completion. Too many transactions, too many sellers quickly agree heads of terms without looking at what the other side are trying to do, push it to the legal profession. There's nothing wrong with the legal profession, but they don't necessarily get the commercials behind it, and then you've got a very cold environment in terms of getting that project management through because the parties don't really understand what they're doing. So again, crafted heads of terms, slow up the process of agreeing the heads of terms that you're more likely to get all the different elements right in that document, which then later increases the conversion rate. Our typical conversion rate is 75 to 80% from a project that we take from start to completion. And the reason for that is we take more time looking at the product and asset we've got, we prepare it more effectively, we're strategic when we sit in and we look at agreeing those deals, but also when we look at the heads of term stage, slowing it up and thinking about all the commercials for both sides to make sure it's far more likely to get through that legal process. Transaction assurance, typically 2 to 3 months through to completion once you've agreed exclusivity, and looking for a very high conversion rate. We mentioned earlier, we need to think about a global approach ultimately to this. International research is critical, private equity is critical, but also looking at beyond the same sector trade. Too many people are looking at the M&A processes simply, we need to look just at the competition. Very often the best buyers come off piste. So fundamentally behind that process, just to reinforce, it's a competitive environment, a crafted positioning with the right and best buyers through better business intelligence on an international basis. Let's have a look at how that actually translated to a recent transaction we carried out. So the process of selling a business and a transaction that we carried out last year. So this was a southeast-based medical clinic. It was established for 10 years, 2 doctors running it. They've done very well, historic profits of about 400,000 a year and growing. Fairly high capital intensive business, a lot of equipment in the clinic, so expensive to build. Very, very good single branch clinic. Next step for them would be to go multiple branch. Our doctors looked at their own personal circumstances. They also looked at the capex required to go multiple branch, realised they weren't the right people to take the business to the next level. The cost and the pressure in terms of management of running a multiple branch scenario was not within their skill set. So they looked at their position and decided that they were probably sellers. Came to us, we talked them through where they were, we did lots of adjustments to the profits, and we came up with a model that showed that we felt an EBIT, earnings before interest and tax, of 520,000 was deliverable to the marketplace. We didn't use a PBIT, an EBITDA, which is adding back depreciation. Depreciation was a real cost in this particular scenario. And we mentioned strategic value earlier on, that we valued it at a multiple of 5.5 times that 500, which gave us a forecast valuation of 2.86 million. We looked at that debt-free, cash-free, so we looked at the balance sheet. Any surplus cash would have been added to that deal value. That was the forecast we gave them. We then talked through how we could prepare the asset to go to market and also how best run the process for them in going to market. We went out on an offers basis, marketed the opportunity, 3 competitive bids with a £4 million deal value. So significantly over financial forecast in terms of strategic value. Partly that's the process of a competitive environment, partly also some of the preparation work that we put in place. One of the key areas that we worked on when we were looking at the value builder phase was actually reducing the management that they had in the branch. They actually had a manager running it for them, but they had largely been helping build up and set the business up. And when we actually looked at the roles and responsibilities, it was felt that they were no longer required, which enhanced the profits further when taking it to the market conversation. But the other element, right buyers, competitive environment, competitive process, competitive bids, and also right deal structure. So actually the deal went through 2 million on completion, 1 million deferred payment, 1 million earnout. So quite a high ratcheted deal, but let's look at that. It was a trade buyer backed by private equity, and they had a very strong covenant. So we were prepared to take a deferred payment. But our doctors were quite hands-on, so that deferred payment was dependent on them staying for the next couple of years, which de-risks the deal structure from a buyer's perspective. But it also enabled our guys to get interest on that sum of money. So it was a better deal structure for them. Of course, cash would be even better, but then we're back to the trade-off. If we went for all cash, would we only have been looking at a £3 million deal? Here, a £4 million strategic deal value. So the deferred payment had loan notes in with interest, which presented a very, very good yield for the doctors. So 2 million on completion, 2 million fixed deferred payment subject to them staying. But the other element of preparation that we'd carried out was getting their forecasts in alignment and looking at the sustainable cash flow run rate in the business. So although we looked at a £500,000 adjusted profit, we were actually forecasting out £700,000 profit. And the deal was actually done on a multiple of that growth in profit. So the earnout was their ability to go from that £500,000 profit forecast to the 750,000 over a couple of years. Now the deal was done last year. We're very much on track to achieve those forecasts, so we are achieving that earnout. And as a consequence, we're still very comfortable that we're going to hit the strategic deal value of 4 million. There were other offers which were closer to the original forecast 3, but the deal structure wasn't as exciting and the headline value wasn't as exciting given the partnership we were able to achieve with the buyer. So that's what we mean by strategic M&A. It's competitive process, competitive bids, but also looking at the buy-side strategy and creating a deal structure that maximises it for both sides. The buyers benefited from retaining some of their own cash through the deferred payment, so the sellers helping finance the transaction, but it also locked them in to ensure sustainability and driving the growth of the business forward against those forecasts. Some other examples of this. We've recently carried out an IT consolidator transaction. We've actually worked previously with the buyer, but this time we were acting for the seller. Classic shareholder value play, not a great multiple because their margins are consolidating in the IT services, managed services sector, but a multiple of 5 on the deal value. And the strategic buyer, fundamentally IT consolidator, we're very aware that they themselves are looking to do an exit strategy, so they are buying at multiples of 5 with a view that can they therefore then later sell with a much bigger profit on a multiple of 6 or 7 when they go to market. That's what we mean by finding strategic buyers. Another good example, Delos Creative. We won an award called Game Changer of the Year for that transaction. The trade buyers that we were looking at came up with best bids of 2 million. We beat that significantly with 3 million. It was a care and social care business looking after kids with special needs. One of the issues behind the business was how do you grow it because of the problem of finding housing stock. But by going to a housing association, which is thinking very much off-piste, we solved that problem they could scale it up rapidly, hence a much higher deal value. You see here there's a theme, which is don't always approach the immediate competitors, think slightly outside of those arenas in terms of who's the best buyer, who's likely to be the best buyer. Gateway went to a very large, as a software business, IT software business, went to a very large trade buyer, very strong multiple. Intellectual property, they could cut the cost base quickly and get the economies of scale, but fundamentally also buying a new niche, a new product arena. Meter provider, another transaction we won awards for, £20 million deal value, again very strong multiple, 3.6 million profits at the time we went to market. Historic profits only 2 million, so arguably the multiple even better. Again, strategic value around those forecasts. And then finally, Updata was a very large transaction and one of my favourites. The guy that was actually selling that had taken in private equity 3 or 4 years ago. Again, you can see a very strong multiple. Why was the multiple so high? It went to Capita and they had very strong contracts 6-7 years out, which significantly enhanced the forecastability of the profit. So by using that recurring revenue and also showing that contracted revenue, you could actually de-risk the transaction for buyer, hence get a higher strategic value. The other reason it's one of my favourite transactions is a good example of what people go and do next after a deal. So the seller there has actually relocated down to Devon and is running a manor house with country cottages, which is a really great lifestyle. He's probably one of the wealthiest ditch diggers I know, because that's how what he does, spends his time out there maintaining the property. But I also particularly like this story because he used to go to the same school as me, and he was, after doing the deal, phoned up by the school saying, look, I understand you've done rather well, would you like to contribute towards our trust? He listened to them for about 5-10 minutes, hearing out what they had to say, before reminding them that he had been expelled. So fundamentally, strategic deal value is around preparation and strategy. It's around taking more time and care out before you engage in an M&A process. Thinking about how do you create shareholder value in a deal before you start going to market? How do you do the value builder exercise in terms of preparing the asset to make sure that when you go to market, you've actually aligned it with what the market's looking for? That is more team and market driven businesses where the owner managers are more hands off and the business is growing with future significant growth prospects and also more recurring revenue. How do you set the business up so you can take more time to think about shareholder value strategy in the board? Then employing the right M&A advisor to craft that positioning, data room, due diligence, the right quality information memorandum, and talk to the right buyers in the right way on a discrete, tailored basis to the key decision makers. That then creates a competition, and the competition creates a strategic bidding, which pushes up the deal value and also improves the prospect of a more imaginative, aligned, strategic deal structure, which enables you to secure a better price when you go to market. Thank you for listening.